Hello, welcome to this episode of Rich Insights. I'm Don Rich, Head of Investments for Esoterica Capital Markets. Today's topic is on a coming crisis, right? And the crisis is located in emerging markets. We are on the verge of an emerging market meltdown. Now that can make it come as a surprise to many of you, right? And you say, are you sure? Are you sure? Well, let me walk you through it. And I think I'll be able to convince you. But the reason this isn't getting a lot of attention, right? I can see why you may not be prepared for it is if you think about U.S. equities today, we're down about 14% on the year, right? Year to date, about 14%. Emerging market equities are down about 20%, right? So the easiest, most popular way to invest in emerging markets is through an ETF, a BlackRock ETF called the EEM. EEM, right? And that one's down about 20% in US dollar terms. So one's 14, one's 20. You say, fat guy, what? You really getting excited about that difference? It's not huge. Well, as my father cautioned me, he said, be wary of thick, expensive sweaters because that can hide a whole lot of imperfections. And we're seeing the same thing here with EM today. It is down only 20%. However, if we look under the covers, you're going to be more disappointed than my wife was on her wedding night. All right? Because emerging market basket, the EEM, is composed of about 35% China. Right? That's changed a lot in the last few years. Today, it's about 35% China. And Chinese equities have been holding in much better than other markets. And the Chinese currency has been holding in much better than the other markets. And so looks are deceiving. You say, my emerging market portfolio is only down 20%. I'm really not all that worried about it. Well, again, if you look under the covers, you should be. The only thing that's holding that basket together right now is China. All right, let's look at some charts here. We're going to start here with the exchange rate for Brazil. It's called the Brazilian real. Now, remember how this works. When this line's going up, this means the Brazilian real is getting weaker. Right? The US dollar is getting stronger, the Brazilian real is getting weaker. So you can see from the very start of the year. All right, boys and girls, let me say that again. From the start of the year, not the start of the coronavirus, from the start of the year, this thing's been a one-way train for the most part, right? It has been weakening. And during this relief rally, during this time of turmoil, we're not seeing much in the way of this thing strengthening, right? The stress in these EM markets is back. And in fact, the Brazilian real hit an all-time low today. The currency was the weakest ever in history. But it's not just Brazil. Here, our next chart is the Turkish lira. Again, for the most part, a one-way train. A few gyrations, but not much. It just keeps getting weaker and weaker and weaker. Next, we have the Indian rupee, right? The currency for India is called the rupee. And again, we can see this thing just keeps getting weaker and weaker as we go. Now, the problem is that people are thinking and still talking about this V-shaped recovery. Right? Folks, that is not going to happen. Right? Again, to borrow one of my father's expressions, you might as well be urinating into the wind and expecting to stay dry. You got about the same likelihood as this V-shaped recovery. Right? So we got some storm clouds building, and these are really, really dark storm clouds here. So it started with the collapse of oil prices. All right. Now remember, oil is a consequence of the coronavirus slowdown. It is a consequence, but it's not the only one. There are going to be others. right? So the crash that we've seen in oil is most likely going to migrate to other commodities next, and continue to migrate toward EM, as you see it already has started in the charts today. And so we are on this verge of an emerging market crisis. Now, what has caused this? So we got to step back a little bit. What has caused this? Well, we're to blame. I mean, everybody's to blame, right? We're to blame. The U.S. is to blame because during this bull market of nonstop quantitative easing, we were all continuously pushed out further and further on the risk curve, the risk spectrum. We were pushed out further. And these emerging markets got hooked to that opioid called liquidity, right? That opioid called liquidity. They got hooked on that. So many of these countries were running what's called current account deficits to start with. All right, I'm going to put my propeller head on here for a second. Now, current account deficit is almost always due to a trade deficit. That's all it is, a trade deficit. So you're importing more than you're exporting. Right? It's not complicated. You got to get the econ vocabulary down, but the concept's not difficult, right? So these countries like Brazil and Mexico and so forth, they're importing more than they're exporting. Now, how are you able to do that? Well, because your financial account, right, the flows, the foreign portfolio flows, are subsidizing your trade deficit. Right? It's the same thing we have in the U.S., so it's hard to cast stones, but that's what's been going on. They've been living beyond their means because foreign investors, you and I, have allowed them to do so. And the way this works with the emerging markets, there's always this liquidity concern, right? It takes years and years and years of nonstop capital flows flowing into these countries. And then all of a sudden, everybody wants out at the same time. So the flows going in are a nonstop trickle and they're coming out as a gusher. That doesn't work, right? And remember how this works. So if I sell Brazilian equities, I'm not only selling Brazilian equities, but I'm also selling the Brazilian currency because I want to get back to a dollar investment. So we have this flood of people leaving, investors leaving emerging markets, and that's causing downward pressure on the currency. That's what we're seeing. Right? Now, in addition to that, we also have this trade deficit here, right? So the imports were more expensive than the exports. Now, all of a sudden, the exports have fallen in value, right? Your exports, your products are oil or some other commodity, and suddenly they've essentially become worthless. So their trade deficits, their current account deficits, whatever they're going to skyrocket, right? These things are about to balloon. And it's going to cause real hardship going forward. They're going to have to really slow down their imports dramatically. And there's only two effective ways to slow down your imports. One's to collapse your exchange rate, just to make your imports very expensive. Or two is something they call austerity. Austerity is the polite word for spending cuts when they're trying to slow down the economy. Both are very bad news for folks living in emerging markets, and very bad news for folks investing in these emerging markets. So we've got this huge problem brewing. Huge problem brewing. The catalyst for this is the downturn in commodity prices, right? Obviously, the slowdown gave rise to the drop in commodity prices, but now this is the second order effect. I want to show you one more chart here before we go. Here's a chart of emerging market currencies. All right, I'm going to focus on the worst ones here. And we're looking from the start of February, the February 20th, the start of the coronavirus, to today. All right. The worst performing currencies. Again, Chile, Argentina, India, Turkey's in there, Russia, Brazil, South Africa, Mexico. All right, these are, for the most part, all commodity currencies, all commodity-based economies. Now, remember how this works from an investment perspective. If the Mexican equities are down 20% in local terms, you have to add an additional 23% loss to that. So you're down 20% in local terms. You're down 43% as your all-in return there. All right, so that's a problem. That's a double whammy, and that is life in emerging markets, right? There's two main sources of risk, and during the good times, that gives you two sources of returns. The good times are not now. Right? This is a huge concern. You should take this seriously. The chance of an emerging market crisis, the chance is very high. The chance is very high. That's our message for today. All right, I'm Don Rich. You've just experienced a rich insight. I hope you've enjoyed it. May your beer be colder than the company you keep.